Hi, welcome to the latest episode of the AJBL Money Markets podcast. My name is Dan Coatsworth, and joining me in the hot seat this week is Laith Khalaf. Hi there, Laith.
Hi Dan, good to be back on the Money and Markets pod.
Good to have you back. Now, we've got some really good stuff on this week's show, including a look at the latest twists and turns involving UK takeovers, including Mulberry and MusicMagpie.
And we've also heard from two major names in the athleisure sector this week, JD Sports and Nike. It's fair to say one is a winner and another has been a bit of a loser, so stay tuned to find out which is which.
So Danni Hewson chats to Sam Vecht, who manages the BlackRock Latin American Investment Trust, about ongoing volatility in that part of the world and why it is somewhat cushioned from current geopolitical tensions.
And we'll also be hearing from Shares Magazine's Ian Conway and Martin Gamble about the ins and outs of Wetherspoons. I'll also be looking at big changes to energy bills and the help available to those who might be struggling.
There's a big fight against scams in the UK as companies rally to stop people losing money. So I'll be talking with Laith about this topic a bit later in the podcast.
And finally, we've got some eye-opening figures on the amount of money being poured into cash ISAs. More on that in a bit. But first, we should look at what's been going on in the markets over the past 7 days. Dan, do you want to give us a bit of a lowdown?
Yeah, I mean, the key area of focus has been what's going on with the oil price. So there's obviously ongoing tensions in the Middle East, and that's sort of stirring up worries that we might see disruptions to supply. But we've also got talk that various places in the Middle East might increase supply. So one minute you've got concerns about shortage of supply, and then the next is an increase in supply. So you've seen quite a lot of up and down in the oil price. Now, clearly, a stronger oil price is good for stocks like Shell and BP, really popular with investors, particularly people in retirement because of they're very generous dividend payers. But naturally, we've also got to keep an eye if we've got a rising oil price and what that means for the costs of energy and transportation for businesses and obviously consumers as well. So we'll be talking a little bit about energy costs for consumers in a second on the podcast. But I think the oil stuff is something to keep an eye on. Currently, Brent crude is sort of hovering around $74, $75 a barrel. So, I mean, we've seen it way above 100 going back a little bit. But I think it's one of those things where people are saying, okay, I'm expecting inflationary pressures to ease. They perhaps are not expecting oil prices to suddenly go back up after being down for a while. So I mean that's the key thing. The other thing is we talked about a bit on the podcast last week is about there's big stimulus measures in China. That's really put the spotlight on Chinese equities. They've had such a really strong run, strongest short-term performance we've seen since 2008. And so naturally, lots of people are looking at that area and asking, okay, what's on offer for investors, particularly in the UK? You can get exposure via funds and investment trusts. There are companies that do business in China on the UK stock market, such as all the big miners, and there's people like Burberry, and we've got Prudential. So it's interesting that you've got oil and China right front of mind for people, and actually, what things like AI and tech, which have always been flavour of the month. A lot less said about them at the moment. Whether all we need is just another case of another set of results from those big tech companies to get their focus back on it. But it is interesting how we've seen a slight shift here.
And sort of aside to that, it also feels like the kind of takeover machine has been working on overtime, certainly in the UK stock market this year. And there's been a couple of moves on that front more recently, haven't there?
Yeah, so we've had a month of Australia's REA trying to buy Rightmove. It's finally basically come out and said it's not going to continue its pursuit. Rightmove clearly doesn't want to be bought at the type of money that REA is offering. So effectively, we've now got this. That's the second FTSE 100 takeover situation this year, which has kind of been defeated. The first being Anglo-Americans stopping being taken over by BHP. So there's lots of chatter about how the UK stock market is really cheap. It's a hive of activities, takeover activity. That's still true, but it also shows that shareholders and companies themselves, the board of directors, they're not all going to just accept the first bid that comes along. And I think that's a really healthy situation, because we don't want companies simply to sort of just say, okay, well, they're offering 20, 30% above the market price. That's a nice little kicker for shareholders. Let's take it. We actually want to keep quite a lot of these companies that are on the stock market. We want them for longer term opportunities. We don't simply want to see everyone sort of disappear. But there's still, despite Rightmove defeating its takeover interest, there are a couple of small companies that are subject to interest from different parties at the moment. One is Mulberry, the luxury handbags group. It's rejected a takeover offer from Frasers. So Frasers is, if you're not quite sure, you might not know what that company does. It's you know it by some of its brands. It's best known as being owner of Sports Direct, majority owned by Mike Ashley. So Frasers owns 37% of Mulberry, but it's not the biggest shareholder. There's a Singapore sort of investment company that owns 56% of it, and essentially they don't want to support a takeover by Frasers. They've got their own interest in the luxury market, so that's one to keep an eye on. The other one is MusicMagpie. So I mean, Laith, I can see that you being a man on a quiet night, having a browse on eBay, seeing what bargains you can buy. You've been buying the complete works of Bruce Willis on DVD, perhaps.
I wish. That's a great idea. Definitely got Nicolas Cage. I need to add Bruce Willis for sure.
So, I mean, MusicMagpie's got sort of developed this reputation of being, it's one of the really big sellers on eBay, or you can buy directly from it, to selling like really DVDs for pennies and CDs as well. But also it's got a business where it buys old phones and laptops from people. It fixes them and it rents them out. So AO has come along and said, we'd like to own MusicMagpie. We've made a takeover offer. So you're thinking, well, crikey, MusicMagpie is a business in, well, let's put it mildly, it's not in great shape. It's got a really big amount of debt. It's not been doing very well. It's lost significant amount of value since being on the stock market for about the last 3 years. So, I mean, AO might think it's getting a cheap price. But AO as a business itself went through a few pains. If you go back a few years ago, it pulled out of Germany. It's spent a while trying to sort of stabilize operations in the UK. It seemed to be in a much better position this year. Maybe it's sort of prepared to take some risk, to take on MusicMagpie and become a big name in electrical recycling. So I think everyone knows AO for a website. You can go and order a washing machine or a fridge. But actually, it does a significant amount of stuff behind the scenes with electrical recycling. And so it's come along, and MusicMagpie is its latest target. So I don't know what I don't see a situation where someone else will perhaps come along and try and want to do a rival bid. There was some speculation that BT was interested in it a while ago, but no, I think that, I mean, so essentially what's happening is still takeover activity, still going along, but deals aren't basically being snapped up as soon as someone makes the first offer. There is a little bit of pushback here.
And we also, at the top of the show, mentioned results from Nike, never know how it's pronounced, but Nike and JD Sports. And one has been quite good, one has been quite bad. Which was which, Dan?
Well, Nike's got a lot of problems, and it came out, and whilst it beat expectations with its latest results on certain measures, it withdrew guidance for the year, and it cancelled a big investor presentation about its strategy, because essentially what's happened is it's getting a new chief executive in the coming weeks. And so it sort of basically said, well, we're going to wait for this new person to come in and bed down. And so the market was like, well, we don't like the sound of this at all. You've got problems. If you're withdrawing guidance, that means that you're not confident at all about the near term. So Nike has been criticized for relying too much on some of its sort of iconic old brands. And so it's not keeping up the times. It's had other companies come in and essentially take some of its market share, like Hoka and On Running. It just seems to be struggling. So it's come out and said, it's confident about picking things up, but it's just a business that's going through some very tricky sort of strategic changes. It's trying to work out how it's going to get back on top. This sort of proposition it had of trying to sell direct to the consumer rather than doing everything through retail shops hasn't quite worked, and that's been a real area of pain, and it's not getting any better. But and then you got JD Sports, who a few hours later, after Nike's results came out, JD Sports results came out, and they were way better than expected. Now, its shares also fell on the news because it's warning about some currency headwinds. But as a business, it seems to be doing pretty well, and it kind of shows that people like to go to a shop. They like to choose from different things, see what's available, and it's done very well. And interestingly, he said the strongest part of this business was sort of sneakers, so exactly shoes that Nike sells. So, Laith, I think, can we blame you? Have you not been buying enough Air Jordans recently?
I haven't. I've got a bit of a bee in my bonnet about athleisure, actually, Dan, because I occasionally like to go to shops and buy actual sports equipment or sports clothes. And you go into a shop like JD and it's just old fashioned. And as you know, that's not for me. So I'd quite like to see a few of the old, good old sports shops like Intersports back on the high street. That would really, put a bit of a spring in my step.
So I mean, this term athleisure it's a bit cheesy, but it's become this really big industry. Particularly, lots of people happy to wear gym equipment as everyday clothes. They're happy to wear running shoes as everyday shoes. So it certainly still seems to be going places. There are a few companies in it that aren't doing as well, like Lululemon is finding life a bit harder. But I think JD sort of shown that if you offer someone a really good range of products in a nice way, good shops, invests lots of money in to make its shops good, its website, online service is really good. It's really paying dividends for the business, and obviously shareholders have done very well by owning JD Sports shares, particularly over the last sort of decade. But yeah, so thanks, Lee. So let's move on to some personal finance stuff. We're going to talk about energy bills. Unfortunately, they're going up again. Bad timing, given how cold it is. I'm sure many of our listeners have had the heating on over the last few days. I certainly have. So Laith, what's going on with energy bills then?
Yeah, so this is the energy price cap, which regulates the maximum that energy companies can charge per unit of energy. And that's going up. It's gone up this week, actually, from the 1st of October. The energy price cap rising by 10%. So for a typical household, that equates to around £12 more a month. So, we're not back to the bad old days when, the price cap actually worked out around over £4,200 for a typical household over the year. It's now estimated to be more near to around £1,700. But obviously, as you say, still a pretty unwelcome change in direction, especially when we've kind of got to a place where we're expecting inflation to come down, and I think that has obviously happened. But now we are seeing kind of more moderation in that trend, and actually wholesale energy prices ticking up again. I mean, the good news, such as it is that actually in recent weeks, after the kind of period which sets the price cap, we've seen wholesale energy prices fall a bit. And these are obviously quite volatile markets, but based on current expectations, it looks like in January we're not going to get this kind of ratchet effect where the energy price caps keeps going up. It actually looks, based on present forecasts, that it will fall back. Of course, that's not set in stone, and we'll have to wait until it's actually set in November. But that's kind of a little bit of perhaps an improvement on the situation that we had at the kind of height of the energy crisis. Of course, back then we did have much more government support, and that's now been withdrawn for all apart from those on the lowest incomes on benefits. And of course, more recently we've had that announcement the government is going to means test the winter fuel allowance. So this increase in energy prices, I think, really puts much more of a spotlight once again on that policy decision. So there are things people can do to manage manage their bills. Like I say, there are a number of support schemes from the government for those on lower incomes. If you think that might be you, then have a look on gov.uk. That's a very good website with lots of information on the various support schemes that are on offer. More practical advice is perhaps shopping around for the best tariff for you. Many households are on variable tariffs. There may be some fixed rate tariffs which are better for you. Also, kind of focusing on energy efficiency. In terms of appliances, draft excluders, keeping windows closed, keeping curtains closed, that sort of thing. Only heating rooms that you're in, turning the kind of thermostats down in other rooms. So there's stuff that you can do there, and potentially consider getting a smart meter. Over the years, they have got quite a lot of bad press, but they can also give you the information to help you keep on top of what you're paying out, what you're using in terms of energy, and hopefully give you the information to help you make better decisions as well.
So thanks, Laith. Let's move on to some new data looking at the amount of money that the nation holds in cash ISAs. Now, we've talked on the podcast before about how many people have sort of flocked to cash ISAs while interest rates have been high over the last couple of years. But I'm just wondering if that trend might have now peaked, given that interest rates are starting to fall. But Laith, I presume that the latest data is obviously it's backward looking, and it might not run up until the last few months. What have you got then?
Yeah, so the latest data is really to August. And if you look at the year to August, then you've got £17 billion more going into cash ISAs than in the previous year. But of course, as you say, over that period, we've seen a very large increase in interest rates. They've become much more attractive. And of course, as interest rates have increased, so has the appeal of the tax shelter that's provided by the cash ISA as well. Because if you're getting diddly squat interest on your cash, then having a cash ISA doesn't really bother you because you're paying diddly squat in tax. As soon as you start getting a reasonable return from cash, actually tax becomes an issue. If you look at kind of the more granular data, there's been a bit of a slowdown in August. This was before the kind of the interest rate cut, but we've had some fixed rate products have dropped their rates already, because if you're looking at a 12-month fixed rate product, that actually looks at interest rates over the following 12 months. So in August, we had £4 billion going into cash ISAs, and that compares with £5 billion last August. A little bit of a drop off, but I would say that actually those are still very high numbers for August. And I think that is because people still are finding the rates that they can get on cash pretty attractive, particularly after the period of low interest rates that we've had for so long, where people really couldn't pick up any yield or very limited yield on their cash. We also saw cash ISAs take a real hammering in terms of the amount going in when the personal savings allowance was introduced in 2016, which basically provides you with a certain amount of cash interest every year that you can receive tax-free. Now, that's £1,000 for basic rate taxpayers, £500 for higher rate taxpayers, and a whopping £0 for additional rate taxpayers. But what that meant is, combined with lower interest rates, a lot of people didn't bother with ISAs, cash ISAs, because they weren't paying tax on their interest anyway. And now that we're getting interest rates of 4 or 5%, then actually it is much more of an issue. So we've seen them perhaps a little bit of a tempering, but still a lot of money going into cash. And, I think there is this question, are people holding too much cash? Because, standard financial planning suggests that you should hold 3 to 6 months of your living expenses in cash in case of emergencies. And anything above that, you should perhaps think about taking some investment risk to harvest higher, longer-term returns, albeit with greater volatility. And I think it's quite interesting. The FCA definitely thinks that people are holding too much cash. So in 2021, it actually said it wanted to reduce the number of people holding more than £10,000 in investable assets, wholly or mainly in cash. And in 2021, its target was to cut that figure, that number of people holding that amount of cash, by 20%. Since then, the number of people holding that amount of cash has actually increased by 40%.
Wow.
So they are way off target. It's going in totally the wrong direction. And of course, that is because a lot of this stuff isn't really in the regulator's control. You can scream to the rafters about how long-term returns are better in the equity markets. But when you've got interest rates going from almost 0 to 5% in a short space of time, that's really going to impact on consumers' behaviour. So perhaps early signs that maybe interest rates are waning and perhaps taking a bit of a toll on investors' appetite for cash, but it's still pretty strong.
Thanks, Laith. Last week, I asked if listeners had any requests for companies you wanted us to talk about on the podcast. And we had one listener called Steve Wright who got in touch with a suggestion that we discuss the UK pub giant Wetherspoons. Now, the company should have reported its latest results by the time you hear this podcast. But just ahead of those figures coming out, we managed to get Shares Magazine's Ian Conway and Martin Gamble to sit down and share their thoughts on the company. So let's hear what they had to say about Wetherspoon.
The company said in a pre-trading update that it would meet market expectations for the year, and currently they sit at revenues just over 2 billion, which would be a record, and a pre-tax profit around 72 million. Now, to give that some context, we'll talk about some of the headwinds that hospitality's faced shortly, but back in 2018, before the pandemic, they were 107 million. So there's a lot of work still to be made up, or a lot of ground to be made up for the profit side of the business. But certainly in terms of sales, like-for-likes, people going back to pubs, it's a good message, and we've seen it all year. I think you've got some data you pulled out earlier on the hospitality sector in general.
Yeah, I mean, you mentioned that sort of mid-single-digit like-for-like sales growth that has been the norm for these guys. I think up to, mid-July, it was up something like 7.7%. And that slowed a little bit from the first half up to January, which was just under 10%. But it's pubs are definitely in the sweet spot. That pub part of hospitality has been doing a lot better than bars and restaurants. And I think you've made a point previously that it's maybe has a slightly older client base, but I think that is changing. The other thing you mentioned on the margins, as I say, pre-tax profit forecast is 72 million for the year to July. They were making over 100 million back in 2018. Part of that headwind has obviously been labour costs. And of course, we had the rise in the national living wage back in April. But good news on that front is, and this is something that was echoed by Mitchells and Butler, is that inflationary pressures are, quote, normalising. In other words, coming back down again. Again, maybe to put Wetherspoon in a bit of context, 2 billion of sales this year is about the same as the market forecast for Greggs, the food-to-go retailer. So that's the kind of size of the business. And actually, Greggs this week also said the same thing, that input costs are moderating, and they think that cost inflation is going to be at the bottom end of their 4 to 5% range now. So it would seem that these businesses which have had these huge headwinds, this all seems to be easing, which is good news.
Yeah, they've been really unlucky, the hospitality firms, because they had the train strikes, they've had weather issues, they've had the national living wage to deal with. They've really been hit hard because of the structure of how they operate, with lots of people to pay. I mean, I think Tim Martin is a bit like Marmite, isn't he? Tim Martin, love him or hate him, but he's certainly a character, and he basically tells people that since 2019. Labour costs are up 164 million, energy costs up 28 million, repairs 38 million, and obviously interest rates have gone up. Interest bills gone up by 16 million. So there's a lot of ground to make up for these firms now that those costs are potentially abating. So investors will be looking at what they say about the future. Is Tim Martin going to have a rosy outlook or not? And for the market, it's looking at like 2 billion it's looking for 2025 revenue growing further 5% from that 2 billion level, and pre-tax profit going up 17% to 84 million. So there's a lot of expectation in the market already. So it'd be important to see what Martin says about the outlook in the future.
Yeah, absolutely. I mean, we haven't touched on it. It's never been really an income stock, but what we haven't touched on is the dividend. And as you say, since 2019, they've had these huge cost increases, that was the last time they paid a dividend. Are we thinking maybe they might get back to paying dividends?
It's a possibility, but this year already, from the extra cash they've been generating in the business, they started off in the first half of the year with an announcement to buy back £40 million worth of shares. So and I think that's been a trend in the UK market as well, as companies perceive their businesses to be undervalued by investors. They think it's a good idea to buy back shares, but it is if their shares are undervalued, of course. So it depends how he wants to distribute that cash to shareholders, but they would expect something, either in dividends or a further share buyback, I would imagine.
Right, gotcha. Yeah, I have got a little bit of colour on trading since July. According to market research firm CGA, which is owned by Nielsen, on a like-for-like basis, drink sales in UK pubs have been up, every month, basically, July, August, September. In fact, they've been up every month since the start of the year, bar April. August like-for-likes were almost 3%, and long alcoholic drinks. And I think this is something we've talked about before. Tim Martin has also said people are going back to drinking pints. So long alcoholic drinks, beer and cider, have been doing very well. High single-digit growth in those. Wine and spirits are really not where it's at anymore. In fact, spirits in August were down. They were down again in September, but by sort of high single digits, whereas beer sales in both months were up kind of mid to high single digits. The other interesting thing from this research by Nielsen is bars. Bars are not where it's at all. People want to be outside, and with the decent weather, obviously if you've got a beer garden, most of their pubs have, that's where people are. So bar like-for-likes in August were down 9% compared with pubs, as I say, up nearly 3%. So if you like the hospitality sector, you definitely want to be looking at, pubs, and wet-let pubs are doing very well.
Yeah, that seems to be the trend, doesn't it? But one other challenge on the horizon potentially is this Labour plan to ban outdoor smoking, which will be another kick in the midriff for companies like Wetherspoons that spend a lot of money and time putting in gardens and outdoor areas. But we'll see how that plays out. There may be political pressure not to do that soon.
So, I mean, as a long-term investment, it's actually not been bad at all, has it?
No, I mean, if you look at the shares more recently, they're up quite a lot from the trough in December 22, I believe. They're up around 80%, but they're still around half the level they were trading at before the pandemic. And that kind of is reflected in that profit number we were talking about earlier. The market's not convinced they'll get back to that level soon. So perhaps that's why the shares are trading a long way below where they were trading before the pandemic. But yeah, on a longer term basis. So, the first pub, I think Tim Martin opened in the 1970s in Muswell Hill. I used to live quite close to Muswell Hill, but I've never been in that particular Wetherspoons. But they incorporated. Yeah, it's still there. And then the company listed in March 93. And since then, the share price, just in share price terms, this is without dividend reinvestment of dividends, the share price is up 1,480%, which works out at around 9.3% a year annualized, which trounces the FTSE 100, which is only up about 3.5%. So the business has done very well over the long term, but of course they went from one pub to nearly 1,000 pubs over that time frame. So they generated a lot of sales and profits, and they actually turned cash flow positive around the late 90s. And if you annualize that number to where we got to before the pandemic, it works out around 20% a year compound annual growth rate in free cash flow. So it's been a very cash generative business and a high quality business before the recent troubles.
Yeah, I mean, you mentioned they opened, they were almost 1,000 pubs. I mean, is that, all we seem to hear nowadays is that lots and lots of pubs are closing. Is there scope, is the plan even to continue rolling out new pubs, or are they, I know one of their big things is that they'd like to find historic buildings. So they could be old cinemas or banks or just something interesting, and they kind of save them. But I mean, what do we know about his plan to open more pubs?
I think I haven't actually seen anything from the company specifically, but I have read research notes which say that they want to get back to at least 1,000 pubs across the UK. They may put more effort towards inside the M25 in London than they have done previously to get there. But you're right. I mean, generally pubs have been closing. If you look at all the studies and surveys, pubs have been closing, and Wetherspoons has been no different. They've reduced their pubs from over 900, and the last time they reported in the year, they said they only had 801 pubs. So they've been reducing the size of the number of the pubs they have, but actually, as I said earlier, they're going to produce record revenues. And so what they've been doing is making changes to the estate where they've got higher quality and higher throughput of people coming into their pubs. So that I think I've got some stats here. Sales per pub are up 21% on pre-pandemic levels. And so that's been part of the strategy, is to make the pubs more friendly, I guess, and more services. They've opened coffee bars, casual dining menus, etc., getting more people through doors, which is their strategy. It's a volume-based strategy, and it's good value for money food, good value for money on good quality beers and drinks generally. And it seems to work.
Yeah, I believe they do breakfast as well. Again, sort of parallels with Greg's openings, but also extending the opening hours and offering more kind of a bigger menu range to people. And clearly that seems to be working. I hadn't seen that stat, actually. Sales per pub up 21% on pre-pandemic with a smaller estate. That's quite an achievement.
Yeah, I think, in his annual report, he gives the weekly sales per pub back to 2014. There were £36,000 a week back then, and today, in the first half of this year, there were just over £56,000 a week. So they've definitely improved the efficiency of getting money out of customers. And it's interesting you should mention the types of establishments they go for as well, because they do definitely focus on churches, banks that have closed, old cinemas, iconic spaces that people recognize as iconic. And I think one of the reasons they do that is because they get lower rents, and then they're big spaces, so they get better unit profit management from it. Yeah, economies of scale, and that's generally the formula that they've been applying over the years. They're definitely a scale player, and they get the advantages. And of course, they don't play any music. Very rarely do they show any football. I think they made an exception for the Women's World Cup, I believe. But generally, you can sit there with your meal and your pint without any interruptions from noisy TV or music.
That makes a real change, I have to say. Yeah, that does make a real change.
Yeah. I prefer that, but I guess not everyone prefers that. So that is their strategy, and it's a well-proven strategy. And I can't see any reason why they couldn't get back up to 1,000 pubs if they could identify the buildings and
get them for the right price.
So that was Ian Conway and Martin Gamble. Don't forget, if you'd like to request a company, a fund, or an investment trust for us to debate on the podcast, send your ideas by email to podcast@ajbell.co.uk, and we'll do our best to feature some of them in a future show.
Right, Dan, shall we chat about frauds and scams, because there's been plenty in the news about them this week?
Yeah, so there's quite a bit of research that's been published, sort of highlighting the problems. But we've also got a few companies and banks talking about what they're doing as well. So some of the headline sort of things, it says that Santander and the sort of think tank Social Market Foundation have put out this new report, and they found that nearly a fifth of UK adults estimated to fall victim to fraud. Now, that was between 2021 and 2023. So the average loss that they found was £907. Of course, this not only sort of causes upset with people's financial situation, but also causes upset from an emotional perspective as well. And I think if you talk to anyone who's been a victim of fraud or fallen victim to a scam. It's awful. It just lingers, and people think that they've done something bad, or they just don't. They totally lose trust. So it's something that the authorities and the bank stuff, they're really trying to sort of clamp down these things. So we've got some mandatory reimbursement rules that are going to come into force on the 7th of October. So, Laith, do you want to run through exactly what these sort of new rules are?
Yeah, so there's a couple of new rules actually. So one is that, as you say, the introduction of a mandatory bank refund of what are called push payment scams. So that's the most common type of bank fraud, where individuals or businesses are basically tricked into sending money to a fraudster's account. So the payments regulator is basically saying banks are now going to have to refund victims up to £85,000 for losses in those push payments scams, which it reckons will cover 99% of cases. There have been some consumer groups who wanted them to go further, because the previous proposal was £415,000 actually. So that's coming in. And at the same time, we've also got banks being given extra time to investigate suspicious payments in an effort to curb fraud. So the Treasury, says banks will be allowed to pause transactions for up to 72 hours where they think there is reasonable grounds to suspect that their payment is fraudulent. Because as things stand at the moment, they either have to process or refuse a payment by the end of the next business day. Though, if the payment turns out to be legitimate and banks have held it up, they may well have to compensate customers as well. So I think all of this combined with the fact that the payments regulator is saying to banks they're going to have to refund victims up to £85,000 and not £415,000 is a balancing act going on here between making sure consumers are protected and also not putting too much pressure on banks. Now, you might say that banks make a lot of profits, so they should be able to shoulder the pain. But I think there is also an argument that the more compensation is paid out by banks, the more complacent it makes us all as consumers, because we just think, well, whatever, the bank will pay me back. And ultimately, that actually makes scamming activity more fruitful, and so it keeps growing. And I think I probably have a fair amount of sympathy for that view. But overall, still a package of proposals which look like they're actually making things better for consumers.
Now, there's something which I must confess I'd never heard of before, but I read about this week. They're a bit like you'd call 111 to get through to the NHS to talk to them on sort of health issues. There's actually an anti-scam service, a phone number. You just dial 159. And I noticed that Revolut, Chase and Modular have just signed up to this service, which means we've now got just over 99% of all UK current accounts are sort of linked to this service. And what it means is that if you've got someone on the phone and you think actually they're trying to trick me into handing over my money, all my personal details, they might be pretending to be a company or pretending to be your bank. You hang up the call, phone 159. They will connect you directly to your bank, and you can obviously then trust that you're speaking to the right person. You're not speaking to someone who's pretending to be your bank. So just to give you an idea of how many people are using this service, Co-op Bank says it receives 10,000 calls every month, typically through the 159 service. It launched 3 years ago, and the operator says it's got over 400,000 calls have been made to the service since then. So I thought that was quite interesting. It's one of many examples of what's going on. And there's also an announcement that that NatWest and Metro Bank have been working with Meta, so Meta, the parent company of Facebook, Instagram, WhatsApp, to try and sort of share information as part of this bigger sort of push to protect people against fraud. So now, obviously, Meta's owning these huge social media networks, and sadly, social media is sort of a hive of activity for people trying to scam others out of money. And one of those areas is concert tickets. We saw it with the Taylor Swift UK concert tour earlier this year, and it seems to be the next area that people are sort of already trying to sort of pretend to be selling tickets is for the Oasis tour. So Meta did a pilot, and it said it found a significant concert ticket scam network attempting to target people in this country and in the US, and it managed to take it down because of the data shared between those involved in schemes. So it had 20,000 accounts from scams removed from social media network, and this is just one example about how it's trying to sort of share information and sort of stop things. But I mean, it does make you kind of nervous now if you look at social media and someone is offering something and you're thinking, well, it might be a product you want, or it might be a ticket to an event, sporting event, or a music event you want to go to. Just thinking, what's the chances of it being a scam? It seems to be so high these days. You've got to be so careful. And I think the sort of the golden rule is perhaps buy products from an official seller. Don't buy it from people who you don't know online, because you really don't know actually who they are. So we just got time for one more segment on this week's podcast. So Latin American markets are often volatile, but actually that region's somewhat cushioned from many of the current geopolitical tensions that might be at the forefront of investors' minds. We dispatched Danni Hewson to meet with Sam Vecht, who manages BlackRock's Latin American Investment Trust, to find out about the ongoing potential from something called friendshoring, as the US looks to places like Mexico to produce goods it would rather not source from Asia, and whether a new president in the White House could change what the fund manager sees as opportunities in the region. So let's hear that interview now.
It's a hugely fascinating area for people when they're thinking about trying to invest in emerging markets. It's certainly an area which is growing in interest, but it's not been a particularly great year so far. So why is that? And has that potentially created opportunities going forward?
So I'd say generally in emerging markets, and this is kind of the story of the last 30 years of emerging markets, it pays to look where other people are less excited. That's been true across all emerging markets, and it's been particularly true across Latin America. So at times when people are concerned, they're probably overly concerned. When people are excited, they're probably overly excited. And that's a general rule, and would have stood people in good stead across all emerging markets, especially Latin America, for the last 30 years. So the reason why the markets have not done particularly well have been for different reasons in different countries, but broadly there have been concerns about fiscal slippage in Brazil. The government spending perhaps a bit more money than people had expected, and people worried about how that's going to be financed. And in Mexico, people have been worried about the results of the election, which took place in the summer. And people, definitely in our mind, wrongly concerned that the results would entrench de facto one-party rule in Mexico. I stress that is a wrong view. Mexico is a vibrant democracy, but a vibrant democracy where many people happen to have voted in favor of one particular candidate. And that's what happens in democracy. If people are popular, they get a lot of the vote. They can then make mistakes. They can then do good things. They can do bad things. But that's the result that we saw in the election. So people have been worried about political change in Mexico, potential changes in the way the judiciary is run, potential constitutional changes, and probably a little too worried about some of those. And that's caused people to be bearish short term on Mexico. And as I said, for Brazil, it's been more an issue that the government spending and a government tax take perhaps disappointed collectively. And that's caused Brazilian interest rates to go higher than people had expected. However, and this is a long-winded answer. However, Brazilian GDP growth is probably surprised on the upside this year, and we're seeing for the first time in many years earnings expectations across a range of companies rising. Inflation has remained broadly muted. And so for us, people's bearishness on Latin America in general is misplaced. And for the prudent investor, and for investors who have a medium-term time frame rather than the next 3 days, this probably is not a bad time to be looking at the region.
So you mentioned volatility, you mentioned elections. I want to talk a bit more about that. But the one thing about that part of the world, when we're talking about so many geopolitical tensions, so much volatility, it is a part of the world that is relatively isolated from some of those tensions.
Totally. As we were just discussing democracy, most of the region is democratic, which is fairly different from other emerging markets. I'm not saying one shouldn't invest in countries that are not democracies, but if we think about the countries that we invest in Latin America, whether it is Brazil or Mexico or Chile or Argentina or Colombia or Peru, they're all very vibrant democracies, and that comes with swings and roundabouts and changes of government, like we saw in Argentina at this time last year, or like we may see in any of the other countries at some point in the future. But what we don't have in Latin America is the violence really between countries that we see perhaps in parts of the Middle East or possibly in parts of Asia. And just a word on geopolitical tension and concerns. It's worthwhile remembering that the old adage of buy to the sounds of cannons, sell to the sounds of trumpets, which was said during the Napoleonic Wars a few hundred years ago, is probably still true today.
Fascinating. I'm sure a number of our guys on money and markets will know that quote very well. Term I want to throw at you now, though, is friendshoring, because we've heard a lot of that bandied around over the past couple of years. Mexico, in particular, being a country that has particularly benefited because of concerns about China. Do you think that will continue?
In a word, yes. I think it is a trend that we're going to see. It doesn't mean that all of Mexico's problems are solved. It doesn't mean that one should just buy Mexico and close one's eyes. Always, for investors in Latin America and elsewhere, investments have to be scaled appropriately. They have to be deliberate and diversified. But it is a structural positive for Mexico. Go to northern Mexico, as I have in the last year, and you will see the extent of investment in that part of the world, not just from the US, but from multiple countries in Asia. And Mexico is one of the few countries in the world which can produce multiple different types of goods at scale, and obviously is geographically proximate to the United States, which is helpful when you're trying to sell them there.
Sticking with the United States, you were talking about democracies, you were talking about elections. The US obviously has an election coming up. There is potentially there's definitely going to be a change in the White House, but potentially Donald Trump could be back in the White House. How might that impact the relationship between the US and Latin America?
I think what's quite interesting is if you go around Latin America, most of the politicians, most of the corporates are gearing up for a change in the White House, which is going to happen. And most of these companies have dealt with Republicans and Democrats of different hues and different views for decades. And I think the politicians will do what they do. The corporates will probably do whatever they do slightly better, whatever the politicians do in all countries. And I think I have no idea who's going to win on November the 5th. I think many people who profess great knowledge have proven to be rather wrong historically. So I can tell you that on the night of November the 5th, I plan to be flying from Brazil to New York. So I will be moving from one of the countries which we're heavily invested in and be arriving that morning for a series of meetings with a new president. Not actually, I guess the new president only really comes in January, but a new president-elect. And I'm sure there'll be all sorts of great forecasts of President X means Y for Latin America. My general view on all of this would be to fade the first day noise in any direction. And if they say President X is elected and this means it's a disaster, or this means massively positive news for whatever, I would probably trade against anything that people say or do on day one, be it positive or negative.
If we find out the result on the 6th of November, it will be interesting. It could go on for weeks and months, couldn't it? So
it definitely has done historically. And we all know that the US electoral system means it comes down to a small number of states. So we'll see what happens. That's the nature of democracy, and we should be proud and happy that we do live in a democracy in the UK, and that the US is a democracy, and there are positives and negatives about living in a democracy. But as has been said historically, it's the worst form of government apart from all the others, and we should be positive and express happiness that we are able to change our leaders, and all too often. We sort of we in the West get into this sort of, oh, isn't it terrible? Isn't it terrible? No, it's wonderful that we have that possibility, and that obviously has positives and negatives.
The one thing that people have tried to second guess all year is when interest rates would be cut. I mean, we've seen markets go up and down and, the expectation rise and fall, but we do seem to be coming down the other side of things. How is that going to impact the region?
Notionally, it should be positive. It's an area of the world where we've got very high real interest rates, and the gap between Brazilian rates and the US rates is very large today. And so US rates coming down should allow Brazilian rates to come down at some stage. And that should be positive for liquidity in the region. In Brazil specifically, we should be positive with the stock market. But it is interesting to note that over the last 17 years, we've basically been in a perpetual bear market in emerging markets in Latin America. And whether rates have gone up or rates have gone down, Latin America and emerging markets in general have underperformed the US. And whether the dollar has been strong or the dollar has been weak, emerging markets in Latin America have underperformed the US. And whether we've had Republicans or Democrats, emerging markets have underperformed the US. And I think we are exiting a period where the answer to all questions is own a NASDAQ ETF. Which has outperformed anything else. And that's really been the right answer for investors for 17 years. And I think we're entering a different environment, an environment where we don't have zero interest rates around the world, or we don't have high interest rates around the world, where we go back to an environment that's fairly normal for the period pre-2007. An environment of the world splitting into three between the West, the East, and the countries in the middle, who actually are benefiting, as we just discussed, from the fact that the East and West are somewhat distrustful of each other, and the countries in the middle can trade with both West and East. So I think falling interest rates would be good news, but actually a change in the overall perception of investors towards Latin America, towards emerging markets would be even more helpful, because many investors have never experienced this part of the world doing well. And as we've seen in China just in the last few days, when everyone is extremely bearish about the medium-term outlook for a country, that's when the greatest returns actually suddenly materialize. And I think the level of despondency about Latin America from many places the region in quite a good place, because there's very low expectation in general.
Just finally then, if people are interested in investing in Latin America, if we could start to see this shift, where should they be looking?
First thing I'd say is they have to be thinking about the 3 and 5 year view. No point investing in Latin America on a 1 year view, because something's going to happen. There's going to be a crisis. There's going to be something that happens, and one of the markets goes down 30% in a straight line. And it's just really important to remember about 60 to 70% of all Latin American stocks move 40% or more every year. So one just needs to have a medium-term horizon for whatever one does. And how should one be looking about this? Well, one should speak to one's own financial advisor about what's the most appropriate investment for anyone looking at Latin America. I think Generally, closed-end structures make a lot of sense for people thinking about the medium term in emerging markets in general, because it means there's just a little less volatility about around the size of the assets. Actually makes it somewhat easier for managers to manage, but each investor will have their own needs and requirements. But look for people who have a long-term track record, and investors themselves have to have a medium-term view.
Sam, thank you so much. Fascinating part of the world.
Thank you.
That was Danni Hewson talking to Sam Vecht from BlackRock Latin American Investment Trusts. That's all we have time for on the podcast this week, but don't miss next week's show where Rachel Vey will be here to answer listeners' pension questions, and we'll also be hearing from AJ Bell's Investments Director, Ryan Hughes. Until then, thank you for listening.
Before you go, please remember this podcast is for educational purposes, and the views expressed don't necessarily reflect those of AJ Bell or Shares Magazine. The podcast isn't telling you if a certain investment is suitable or not. Don't forget that the value of investments can change, and you can lose money as well as make it. It's also important to remember that how you're taxed will depend on your individual circumstances, and rules can change. The way an investment performed in the past may not be the same as how it behaves in the future. If you want help, go see a qualified financial advisor.